But I just want to thank everyone for joining us today. Again, note to your colleagues that weren't able to join us, there's going to be a recording of this session. Thanks to Adam Jog for joining us from Imagine Canada. Adam Jog is manager in public policy and research at Imagine Canada, where he currently is working on the organization's investment readiness program project. His full biography is going to be attached to the presentation slides that we have for this session. That's going to automatically be emailed to all of you within 24 hours, whether you're here or that you were absent. Folks are still going to receive that. You can ask questions to us through the question tab. We're going to be looking at that actively with my colleagues, and you can even chat with each other, the other attendees in the session. Adam's going to start with a presentation, and you can ask questions throughout. We'll try to see if we can interrupt his presentation to answer some of those questions, but otherwise there will be a formal Q&A period that I'll help moderate at the very end, and we're very excited to get a bunch of your questions. Before starting up, I'm just going to close a couple windows I have open here and do our virtual land acknowledgement that we always take a moment for at the beginning of our webinar Wednesdays. To begin, we would like to acknowledge the many territories of Turtle Island on which we work and reside. These territories are home to many Indigenous peoples who have lived here for tens of thousands of years and continue to live here. As settlers, immigrants, and descendants, and as visitors, we honor and respect the many Indigenous peoples of this land and territory and hope for a more just future together. On that note, Adam, hey, I'll let you unmute yourself, and we can get started, and just let me know when you want me to swap slides.
Sure, I'll tell you next slide. So thanks, Jean-Michel, for the introduction. I'd just like to start by saying thank you, everyone, for joining, and I'd especially like to thank PFC for the opportunity to share some of our work with you. And so for this webinar, I am going to be discussing a recent survey report that was published by Imagine Canada entitled "Are Charities Ready for Social Finance? Investment Readiness in Canada's Charitable Sector." We can go to the next slide, John. And so I just wanted to start by giving you a more specific overview of what I'll be talking about. So I'll begin by discussing some terminology and providing some examples of social finance. I will then discuss a bit of the background on Imagine Canada's research project. Next, and this is really going to be the bulk of the talk, I will focus on key findings from the research. And then I will wrap up by relating these key findings to our main research question, which is whether charities are ready for social finance or not, and what the answer to this question might tell us about the future of social finance within the charitable sector. So we can go to the next slide. And so I wanted to start with the definition. And so really, what is social finance? And we can go to the next slide. And so social finance is an approach to investing that seeks a blend of social, cultural, and/or environmental impacts, as well as financial returns for the investor. And I just want to reinforce that it is the delivery of both of these things. So a societal impact of some kind, as well as a financial return, rather than just the delivery of one or the other, that I think makes social finance distinct. And this is a fairly common definition of social finance, and it's the one that we've adopted in our research. So we can go to the next slide. Thank you. So to better understand what social finance is, it can be helpful to see how it relates to other similar terms that you may be familiar with. And in that sense, I think that this visual is really useful. So this visual illustrates a continuum of investment approaches. And I took it from the Government of Canada's Social Innovation, Social Finance Strategy Co-Creation Steering Group report that was published, I think, in the summer of 2018, I think. And they had adapted this visual from a Mars Center for Impact Investing report. So if we look at the continuum, it runs all the way from traditional investing at the far left, where the focus is overwhelmingly on financial returns, all the way to a group of approaches that are collectively defined as social finance. And so looking at social finance, which kind of serves as an umbrella term, we see that impact investing and community investment are sort of lumped under it. And social finance and impact investing can have very similar definitions, but there are those who say that they're not the same and should not be equated. In this visual, while it illustrates the overlap that does exist between these two concepts, I think it essentially sort of maintains that same sort of distinction. And so if we look more closely at impact investing, we can see that there are differences in terms of whether the intention is to seek a market rate of return. So this would be the sort of finance first box, or whether some trade-offs are acceptable in order to achieve a societal impact. So whether the investor would be willing to accept a below market rate of return. And this is the impact first box. And also looking at this visual, you'll see that responsible investing and socially responsible investing are not considered to be types of social finance. And I think that these two approaches are not considered to be types of social finance because the delivery of some sort of positive societal impact is not what's really being sought. It's more about making investment decisions that are based on sort of values alignment. And so we sort of see that they focus on ESGs, which are environmental, social, and governance standards that potential investees are kind of compared against in order to make investment decisions. And so this is, again, a sort of useful visual for understanding where social finance may fit in relation to other sort of similar concepts.
Adam, we have a little question from Florian asking, is finance solidaire different from a mere translation of social finance?
If I understand the question, I'm not sure if it's possible to follow up if I misunderstand it, but I don't think that finance solidaire is, at least in terms of the visual that we're looking at here, is this the sort of same, is to be equated with the concept of social finance. If I'm looking at the visual here, I would sort of understand finance solidaire to focus more, to lean a bit more heavily in terms of the societal impact part of the calculus. Whereas I think impact investing also includes, being able to lean more heavily towards the financial returns kind of calculus of the investment decision. I'm not sure if I understood that question.
We can always look back to it to, oh, that was the question. There was a thank you.
Okay, thank you. Oh yes, so I don't, to my knowledge, there isn't an English equivalent term. I think it's just the term that's used as finance solidaire. Yeah, so we can go to the next slide. Yeah, so I thought it would be a good idea to talk about some examples, which can be helpful for giving us a sense of what social finance looks like, especially in the sort of charitable nonprofit sector context. And when it comes to the charitable sector, social finance is really going to look like debt financing at favorable terms. And so I've chosen 3 examples that you can see on the slide here. And the first one is the Community Forward Fund, which is a fund that invests in the charitable and nonprofit sector in the form of loans. So they tend to lend to small and medium-sized organizations. And their website has a list of examples of organizations that have accessed the fund. But I'm just going to pick a couple that I saw that were good illustrations. So one is an example of a nonprofit working in the social services sector, providing peer and family supports. And they were relying on government funding, but some of that funding was being withheld until reporting and outcomes could be delivered. And so they accessed a loan to support their cash flow needs and to support continued operations. So essentially, they accessed a loan to serve as a bridge in order to help them bridge that sort of gap in funding that they were experiencing. So that's one example. And another example here under the Community Forward Fund is a nonprofit that works in the renewable energy sector. And so there was a provincial government program that was launched that allowed organizations to be paid for feeding electricity into a grid. And so this organization accessed a loan in order to purchase solar panels so that they could take advantage of that government program. And so the purchase of these solar panels using that loan helped them to reduce their environmental footprint. And it also allowed them to develop a sustainable revenue source or revenue stream. So that's Community Forward Fund. And kind of moving on now to Sketch. So Sketch is a community arts enterprise that works with at-risk youth in the Queen West neighborhood in Toronto. And they offer arts programming. So for example, they run workshops where youth can come and create art. And they've launched a campaign to raise $4 million to purchase the art studio space that they currently rent. And they're doing this because real estate prices will eventually make their rent unsustainable. And so they're raising money by asking for donations and also by issuing community bonds. And so community bonds are a type of social finance. And generally speaking, how it works is a charity or a nonprofit would create these bonds and then sell them. And they would use that money to purchase a capital asset. So in the case of Sketch, it would be to purchase the art studio space. And then the people, the organizations that bought the bonds would be paid back the principal and the interest at a later date. And a really interesting thing here with Sketch is in terms of how they've structured their community bond offerings. So they have a type of a community bond that is the first of its kind in Canada, but I think the first of its kind just in general. And essentially what it is that the financial returns that bondholders would receive can instead be donated back to Sketch. So they sort of built in an option for giving back financial returns in the form as a form of donation, which I thought was kind of neat. And then the sort of last example here, and I'm sorry if it's a little self-promotional, is Imagine Canada. So Imagine Canada has 3 earned income generating activities, one of which is a platform that connects nonprofits with grant opportunities, and it's called Grant Connect. And so Imagine Canada obtained a $400,000 line of credit to support the rebuilding of Grant Connect. And in comparison to what some other lenders might offer, there's a great deal of flexibility here with this line of credit. So the interest rate is 4% per annum. It's payable annually. And the repayment terms are tailored to Imagine Canada's circumstances. So to our timeframes and our expected cash flows. And so it's that the line of credit has sort of been tailored around our sort of circumstances. And I think Imagine Canada obtained this line of credit in 2019. And there's a structured series of repayments. And the first would be in 2022, followed by another one in 2023, and then a final payment in 2024. And so those are just some examples of social finance. And
there's a little question here, Adam, that I'm pretty sure that you've covered, but I still want to acknowledge it. That was sent in by Daryl. Sure. Where do social investment bonds fall within the social finance continuum?
Oh, like the community bonds? I think, I think community bonds would probably fall probably closer to the community investment. My sort of sense of it would be would fall closer to the community investment sort of side of that investment sort of continuum.
Thanks.
Yeah, no problem. I think we can. Yep. Yeah, great. Thanks. So now we've discussed some terminology, and we've looked at some examples. And so I just kind of want to shift a little bit, and just kind of provide some background on our research project. So we can go to the next slide, please. And so Imagine Canada is a partner in the Government of Canada's Investment Readiness Program. And the Investment Readiness Program is a $50 million 2-year program that seeks to build the capacity of social purpose organizations, such as charities, to be able to participate in Canada's social finance market. And it is especially meant to align with the Government of Canada's Social Finance Fund. And I'll speak more about this towards the end of the talk. So Imagine Canada received a grant from ESDC through the Investment Readiness Program to conduct a survey, the aim of which was to provide a high-level assessment of charities' investment readiness So their ability to attract and repay social finance investments. And unfortunately, there's a lack of data on the readiness of charities, and this is the sort of the evidence gap that we were trying to fill. And with the results, we're hopeful that they can help, that they can be used to help raise awareness of social finance among charities, and then also to help other social innovation, social finance actors to work more effectively with charities. And so, these actors include governments, social finance intermediaries, and social finance investors, of which foundations can be considered a part. And kind of shifting to the next slide, please, Chancellor. So in terms of our methodology, so we conducted an online survey earlier this year from January 22nd to March 15th. And we surveyed over 1,000 registered charities from across the country. And the survey results that we got, they were weighted according to revenue size, the subsector that charities operate in, and the region where they're located. And we did this in order to account for any sort of differences between our survey sample and the population of in-scope charities. And by in-scope, we mean charities that had annual revenue sizes greater than $30,000 or greater, and that were not religious congregations. And the weighting is really important because it gives us a certain degree of freedom to be able to generalize our findings beyond our survey sample. And so that sort of brings us to the actual survey findings, which we can get into now. Let's switch to the next slide, Johnson. And thank you. And so we asked our survey respondents a variety of things having to do with the topic of social finance. So we asked them about their awareness of social finance. What do they think of it? Do they want it? How would they use it? What barriers would they face if they were seeking social finance? We asked about their organizational capacity and areas that we've linked to social finance readiness. And we also took a look at their current financing. And more or less, this is sort of the way that I've organized things here. So you'll see that the results are grouped into sort of key themes. And what I'll do is I'll go through the results in essentially that same order. We can start with awareness here. So we asked respondents how familiar they are with the general concept of social finance. And the main finding here is that a majority of charities have a low awareness of social finance, which is not all that surprising. This is what we had suspected going in. We conducted a lot of stakeholder interviews while we were developing the survey questionnaire, and this is what we had been hearing. But I think what may be a bit surprising is the scale of the awareness problem. So for instance, 34% of respondents said that they had never heard of the term social finance before participating in our survey. And an additional 32% said that they heard of the term, but they're not clear on the details. So that's 66% of charities that we're sort of characterizing as having a low awareness of social finance, which is pretty sizable. And in terms of who's more likely to be aware of social finance, so that would be larger charities. It would be charities that operate in the grant-making, fundraising, and volunteerism subsector. And it would be charities that serve more than one province or territory. In terms of who's less likely to be aware of social finance, that would be smaller charities. It would be arts, culture, and recreation charities. And it would be charities that serve smaller geographic regions like a city or a town or neighborhood, rural municipality.
Adam, I've got two questions here related to charities that you're mentioning. The first
Sure.
one from Nathan asks, does your definition of charities include cooperatives? If not, why?
So that definition of charities, so the sort of definition of charities that we're using here would be a registered charity. So it does not include cooperatives. And sort of the justification for focusing on registered charities is that we rely heavily on T3010 data. So on data that's sort of collected through forms that charities have to fill out when they're doing their taxes. And that access to that kind of data allows us to be able to provide results that are representative. So I think that's sort of the justification for focusing on just registered charities.
And the second question received here, it's from Katie. Was there representation of charities outside of urban centers?
Yeah, for sure. For sure. So I think sort of how I would sort of address that is that, you know, in terms of representation, we really look at it in terms of, we really break it down by province. And then in terms of whether it's outside of urban centers or not, I'm just thinking, we did ask a question on our survey in terms of the sort of geographic area that charities primarily serve. And I think 45% of the respondents said that they serve a neighborhood, city, town, rural municipality. You know, it doesn't necessarily tell us whether they're, that doesn't necessarily tell us whether they're in an urban area or not. So unfortunately, I'm not quite able to, I'm not able to be quite that specific with the results.
Thanks.
Yeah, if we can take a look at the next slide. Yeah, so we just kind of here looking at what charities think about social finance. One key finding is that charities generally have positive opinions about it. And what we mean by positive is agreement with a series of statements about social finance, which you'll see presented here in this chart. And so if we look at that chart, you know, for instance, we'll see that charities, they tend to agree that social finance will give investors a better understanding of charities. They tend to agree that it's a win-win for both investors and charities. They tend to agree that it's likely to improve their impacts, and also that it's likely to improve their financial sustainability. The results are a bit more, the responses are a bit more mixed when it comes to the question of whether the risks of social finance will be shared equally among charities and investors, and also a bit more mixed when it comes to the question of whether social finance will likely crowd out other forms of funding for charities. And I sort of just want to add a kind of comment on that, the last one, the point about crowding out other forms of funding. And the mixed responses here resonate with anecdotal evidence, that there is a perception among charities that social finance will become a substitute for grants and contributions, or even the perception that social finance will have a negative impact on philanthropy by encouraging investment over giving. And it's sort of my suspicion that this perception will be an important one to address, and that understanding that relationship, or understanding the relationship between debt instruments and grants will be critical. And if it's the case that social finance doesn't have a detrimental impact on these more traditional sources of revenue, then I think that's a case that can be, that'll have to be made to charities. But that's sort of my suspicion.
There's a little question here that we just got from Lynn.
Sure.
Did the study make any attempt to identify which charities should be candidates for social finance and what percentage that might be? Not all charities will need or want social finance.
Oh yeah, for sure. And so sort of the motivating rationale for the survey was to try to get a sense of the investment readiness of the charitable sector. And so we've sort of constructed a survey that incorporates different aspects of what we consider to be investment readiness. And sort of, I sort of the way we've structured is in the report and also in this presentation, we'll go through a variety of categories and sort of, talk about the results and how charities kind of shake out. And then at the end, we'll sort of talk about, based on all of these results, what does that tell us about the readiness of Canadian charities? And, we can talk about if there's any sort of subset of charities that, are more likely to be ready for social finance. But yeah, definitely that's a good point. Like, it's not going to be appropriate for all charities, and yeah, for sure. And just a final thing on the the opinions piece, is sort of a key finding here is sort of the relationship between opinions about social finance and awareness. So charities that are more aware of social finance are more likely to have positive opinions about it. And conversely, charities that tend to have a lower awareness of social finance, they have difficulty forming opinions about social finance. So they, often they don't know to think about it. So as an example, if we look at respondents that said that they had never heard of the term social finance, 50% of these respondents answered, don't know to each of those 6 statements that were in the last slide. And so that's sort of an interesting thing to keep in mind. And on this slide, we can see demand for social finance. And so we asked respondents, how likely would your organization be to take a repayable loan made available through social finance? And the main finding here is that a majority of charities said they would be unlikely to take a social finance loan. So we see 56% said that they'd be unlikely to take a social finance loan, whereas 19% said that they would be likely to take a social finance loan. And we can break this down even further. So if we're looking at that 56%, 3/5 of these organizations said that they would be very unlikely to take a social finance loan. And if we look at that 19%, the left bar, and we break it down, 3/5 of these respondents said that they'd only be somewhat likely to take a social finance loan. And so the sort of lack of appetite for repayable loans, I find it interesting, given that repayable loans are purportedly the most common form of social finance available. And then, what's interesting about our research too is we start to talk about what drives demand. And so we can see a couple examples on the next slide. And so our research shows 2 drivers in particular that are worth noting. So awareness and opinions about social finance as one driver, and another one is experience with certain debt instruments. And so, looking at the top illustration, we can sort of see what that relationship is between those variables. So the idea here is that charities that are more aware of social finance are more likely to have positive opinions about it. And in turn, charities that have positive opinions about social finance are more likely to say that they would take a repayable loan made available through social finance if it were available. And the sort of chart at the bottom, essentially what that's telling us is that, charities that currently hold term loans are more likely to say that they take a social finance loan compared to charities that do not currently hold term loans. And sort of the way I've interpreted this is that, or sort of a speculation that I have is that, charities that have experience with a certain debt instrument may be more favorable to acquiring the same type of debt instrument or a similar type of debt instrument in the future. But that's sort of a speculation that I have. It's not on this slide, but I sort of wanted to talk about, I guess another driver as well. And again, we see the importance of annual revenue size here, but larger charities, so charities with greater annual revenues, are more likely to say that they would take a social finance loan. And this is especially the case for charities with annual revenue sizes of $5 million or greater.
There's a question that just rolled in from Fluffy M.
Sure.
I'm asking related to the greater awareness. Were charities asked these questions after they were explained what social finance is? Otherwise, given how low the knowledge level of social finance is, there are more guesses than perceptions.
Yeah, for sure. So that's a good question. I can think of 2 kind of ways to address that. Like, so essentially the sort of question about awareness, there is a preamble where we do provide sort of a definition of social finance. So we say that it's an approach that seeks a blend of societal impact with financial return. And we sort of give an example of how it may be used. So either as a means for generating revenue or as a means for cost reduction. And then we sort of say, like, yeah, we sort of note that this type of finance is meant to be easier for organizations to access. So there's a bit of a preamble before we then ask how familiar they are with the general concept of social finance. But it is interesting though, because at the end of our survey, we ask a question, essentially just, now that you're done the survey, tell us anything that you might want to tell us, essentially. And some of the responses there were saying to us, like, it might have been more helpful if, the survey had been preceded by some sort of information providing more details about social finance. But I feel like that would have sort of undermined. I feel like it might have undermined. Like I feel like respondents kind of going into the survey and not being aware of that more or less kind of revealed their actual state of knowledge on the topic. That's sort of my kind of take on it.
Thanks.
Yeah. And so we can go to the next slide, barriers. So yeah, regardless of whether Charities said that they would take a social finance loan or not, we asked all respondents, what barriers might your organization face if it were to seek a social finance loan? And the results are presented here in this chart. And when looking at the chart, we can see that many of the barriers are financial in nature, and just kind of focusing on some of the more common ones at the top. So we see that 25% said that they're not currently involved in earned income activities. We see that 23% said, uncertainty about ability to repay a loan would be a barrier. And then we see that 19% said that lack of assets for loan security would be a barrier. And I think these are particularly substantial barriers in the sense that they sort of speak to difficulty that charities might have in terms of accessing a loan, but then also in terms of generating revenues needed to pay it back. And I should also say that I think earned income is a really important kind of concept for this topic. And when we're thinking about social finance, we should really probably be thinking about earned income or social enterprise as kind of a precursor to that. And just kind of sticking with the earned income theme, we can take a look at a related barrier. Then 17% said no viable investment idea to generate revenue would be a barrier as well. And in terms of looking at a governance kind of factor, we can see that 21% of respondents said their board would not consider or approve of a social finance loan. And this speaks to sort of the risk aversion of charity boards, which, in our conversations with stakeholders, they seem to identify this as another particularly substantial obstacle to social finance. And there are likely many reasons for this aversion. So it could be a lack of clarity on rules around related business. Could be a lack of knowledge of social finance and social finance instruments and how to use them. And someone said to me the other day, they asked whether liability in terms of boards of directors, whether boards of directors are liable if a debt is defaulted on. And I don't know the answer to that question. And I'd actually, if anyone in the audience knows the answer to that question, I'd be curious to hear that and whether that might be a factor for aversion. But yeah, and then there's another kind of barrier that we can look at. It's kind of a human capital piece. But 19% said that lack of staff volunteers with the right skills and experience would be a barrier. And in stakeholder conversations we had prior to launching the survey, we had heard that staff skills and knowledge are really important, especially when it comes to the management of a project where social finance is involved. But I think finding that sort of having that mix of business skills and service skills can be hard to find and hard to balance. And you can see that there are many other barriers in this chart. But I think for the interest of time, I'm not going to go through each one of them. But yeah, but I think actually another interesting one would be look at it. Where is it? I think 9% of respondents said that they're unable to measure the impact of our work, and so I thought that was an interesting barrier because it made me think of whether in terms of what this means, is this an indication of the strength of charities' measurement and evaluation capacity, or maybe does it suggest that some charities don't see the relationship between measurement and evaluation and seeking social finance? And as we'll sort of see in the next section on organizational capacity, I tend to think it's the latter explanation. But yeah.
I've got a little, not a little question, a great question.
Sure.
But to respond to your, would a board consider, I've sat on many boards in the sexual health field in past lives, and fiscally speaking, they wouldn't, I don't remember a single board member or see a single board member of mine accepting to take a loan by fear
Okay.
of their responsibility for it, but that's just
Okay.
from experience. Katie here says, if repayable loans are the most common tools for social finance, how does that impact small or medium-sized charities? Considering the likelihood of core or stable funding to repay loans would be low.
I think it has my sort of response to Katie's question would be that I think it would sort of raise questions of access in terms of whether small and medium-sized charities, whether they would be able to access repayable loans, and whether they'd have the sort of whether essentially whether they'd be ready to take it on even if they wanted it. So that's sort of how I would respond to it. And as you'll sort of see when I sort of talk about the conclusion that I draw from these from our results, I do think there's definitely a lot of skepticism for sure about the ability of smaller charities to be able to access repayable loans, for sure.
And high risk aversion too from board members.
For sure.
Lynn asks, what was the overlap between board being unlikely to approve and answers to earned income, lack, and inability to repay? Are they risk averse? Do we know that?
Do we know that boards, or sorry, can you say that question again?
Yes, sir. What was the overlap between board being unlikely to approve and answers to earn income, lack, and inability to repay? Sorry, I think the formulation of the sentence.
Oh no, it's okay. Unfortunately, we didn't look at the relationship between the different types of barriers. So we don't know exactly whether those respondents who answered that who put the board would not consider or approve of it as a barrier, whether they also would have selected some of the other barriers, such as having to do with earned income or uncertainty about ability to repay. So unfortunately, we're not able to be able to speak to that relationship.
Got it.
No worries. And yeah, so if we can go to the next slide. And so as you'll see on this slide here, what this does is presents an overview of 5 areas of organizational capacity that we sort of identified as being critical for social finance readiness. And so just kind of quickly touch on some of these areas. So measurement and evaluation is about we think it's about the ability to collect data, to evaluate and communicate impact. Looking at planning and program development. Here we're talking about the ability to develop and improve programs and activities that have impact and sort of fit within the organization's strategic framework. In terms of the financial area, we're sort of talking here about the ability to raise revenues and draw on existing assets in order to access and repay social finance investments. Taking a look at management governance, what we're talking about here is sort of the ability for the board and senior leaders to take informed risks and manage staff effectively towards impact. And then taking a look at operations infrastructure, here we're sort of talking about the ability to draw on organizational processes, policies, and procedures, but also to draw on stakeholder relationships, technical expertise, and physical assets in order to ensure that work is carried out effectively. And so we developed survey questions based around these 5 areas. And so we asked respondents 25 questions in total about abilities under these areas to see whether they think it's a strength or a weakness for their organization. And one of the main findings here is that the majority of charities, they rate each ability as a strength rather than a weakness. Another finding, however, though, is that, and as we'll see on the next slide, they tended to express more doubt and measurement and evaluation and financial related abilities. And those abilities are presented here on this slide. In terms of the measurement and evaluation abilities, the relative weakness makes sense given what we know about the challenges with measurement and evaluation in the sector. So lack, for instance, like a lack of funding for measurement and evaluation, time limited nature of the funding, lack of access to data, lack of expertise, technical skill sets. There's a wide wide literature documenting these challenges and many others. And then the sort of relative weakness of the financial sort of area, I think that makes sense too, given the precarious funding environment that charities find themselves in, not to mention the pandemic as well. But like a declining donor base, the shift from core funding to project-based funding, projected declines in government revenues. And so if we just kind of look at a couple examples here with the financial area. So 35% of respondents said that their ability to draw on diverse range of revenue sources is a weakness for their organization. And then we see that 41% of respondents said that the ability to raise unrestricted funds when needed was a weakness for their organization. And it's not on the slide here, but again, sort of the role of revenue size. Larger charities are more likely to report strong capacity across these 5 areas. Then to turn to the next slide, please. And yeah, so this brings us to kind of the last key theme, current financing. And we asked charities whether they currently hold any type of debt. And what we found is that 50% of charities say that they currently hold some type of debt, whereas 48% of charities do not currently hold any type of debt. And for those that do currently hold some type of debt, we asked them, well, what types of debt do you hold? And this chart kind of shows what the answers were. And we'll see, we can see that the sort of most commonly held type of debt is credit cards, 38% of respondents. And that's followed by building leases at 22, equipment leases at 18, and then line of credit 13. And so on. And I sort of just want to point out too, because I had mentioned before that there was a relationship between charities that hold term loans and likelihood to take a repayable loan. And so I just want to point out here that term loans are one of the kind of less commonly held types of debt that we found in our study. So we can go to the next slide, please. And this is kind of just looking at, charities that currently hold debt. What do they use that debt for? And it's the case that overwhelmingly, it's the case that they use it for operational purposes. So 25% said that they acquired their debt to be able to finance day-to-day operations. And the percentage is actually higher than this too. So if we look at towards the bottom of the chart, the sort of other category, 28% of respondents. And if we look at the text responses that some of them provided, and we look into it, and it's really the case that they're telling us that they acquired debt to make small purchases, or to be able to pay daily or monthly expenses. So when we take that into considerations, it's just overwhelmingly the case that they use their debt for financing day-to-day operations. From the next slide, this one takes a look at how charities would use a social finance loan. And I know it doesn't quite fit with the theme, but I put it here for kind of ease of comparison, because I think that there are some substantial differences in the responses to how charities would use a social finance loan compared to how charities currently use their debt that they have. So for instance, just to point out a couple, so if we look at develop and enhance revenue streams, we see that 27% of respondents said that they would use a social finance loan for this purpose, whereas I think it was 5% of respondents, I'm not sure if that's quite correct, what is it? I think it's 11% of respondents said that the debt that they currently hold, they acquired it for the purpose of developing or enhancing the revenue streams. And then, kind of looking at the slide here, it's just in terms of where charities would borrow from. They tend to borrow from banks and credit unions. And then just to point out, the 10% said that they borrow from a foundation charity. And, it's those that tend to borrow from banks tend to be larger charities, charities located in Ontario, and charities that serve a larger geographic area. And then in terms of charities that tend to borrow from credit unions, tends to be smaller charities, charities that are located in Quebec and in BC, and then charities that tend to serve smaller geographic areas. And then the sort of bottom chart there, those that currently hold debt, we just asked them how difficult they anticipated it would be to make the repayments. And what we saw is actually that the majority of charities, 81%, said it would be no difficulty at all. And so that sort of brings us to, I think, sort of, some of the main conclusions we draw from all of these results. And so we're really, looking at everything that we just looked at. we can go back to the primary research question, which is, are charities ready for social finance? And to answer that question, I sort of want to start with a quick definition of what investment readiness is. And so it's generally defined as key characteristics or attributes that of an investee that allows them to be able to attract and repay an investment. And so if we look at, for instance, the organizational capacity stuff, each of those abilities could be considered to be key characteristics or attributes of investment readiness. And if we, I think that's valid. But I would also consider things like, investment awareness, so awareness of social finance, or even attitudes about it to be key characteristics or attributes of investment readiness as well. And that's sort of, for our report, that's sort of the way we see it. And so based on the results, our sort of main conclusion is that many charities are likely not investment ready. They're likely not ready for social finance. And again, so the low awareness that we saw, many charities don't know what to think about social finance. They don't have formed opinions about it. The lack of demand for repayable loans. Some of the barriers that they reported were quite substantial. And then the reported weaker capacity with measurement and evaluation and financial related abilities. So kind of looking at it holistically, that's sort of the conclusion that we come away with, that many charities are likely not ready for social finance. And I think this is a defensible conclusion. It's anecdotally supported through conversations that we've had with leaders in the charitable sector or leaders who have worked with charities who tell us essentially the same thing, that it is likely a small percentage of charities that are actually ready to take on social finance. And just sort of quickly, before moving on to this slide, just if there is a subset of charities that are likely to be more likely to be ready for social finance, it would be larger charities. So for instance, we saw that their larger charities are more likely to be aware of social finance, more likely to have positive opinions about it, more likely to say they would take a repayable loan. They report more likely to report strong organizational capacity. So it's larger charities, if there is a subset of charities that are more likely to be ready for it. And then this slide here, so we sort of answered the primary research question, and then kind of now what. And so we gave some thoughts to what some of the larger implications might be of our research. And I just want to spend a bit of time going through some of those implications. And so we can go to thank you. So first, kind of what does this mean for expectations around social finance? So sort of one narrative that I'm familiar with around social finance is the idea that this approach has tremendous potential to solve the world's greatest problems. Social purpose organizations are integral to this narrative. The sort of narrative that by tapping into sources of private capital and mobilizing it for social good, we can use the power of markets to sort of tackle deeply entrenched societal issues. And so social purpose organizations like charities are integral to this narrative. These organizations, they make important contributions to our society in the form of delivering on social, environmental, economic, cultural outcomes of value. And the development of a market that's capable of solving the world's greatest problems, I think really hinges on whether these organizations are able to participate in that market. So are they able to absorb the capital and have impact? But when it comes to the charitable sector, I think these expectations are a bit inflated. And so we've seen in other jurisdictions, such as the UK, where there's a lack of uptake of this kind of capital. In our report, we talk about how the lack of uptake, or just in general, the question of uptake will be a major challenge for Canada's Social Finance Fund. And sort of one argument that's presented for the lack of uptake is that charities or social organizations in general, they weren't investment ready. So that's why there was a lack of uptake. And sort of given our conclusion, I think expectations regarding the role of social finance in the charitable sector need to be tempered. A related point about will the development of Canada's social finance market be inclusive? So again, I think if social finance is going to be able to solve these challenging problems, it's also going to depend not just on the volume of participation, but also on the involvement of a diverse range of organizations that are able to address a wide range of needs and issues. And I think if it's larger charities that are able to participate in this market, that this would sort of result in a narrowed range of needs and issues that are being addressed. And so I think there are reasons to be skeptical about this as well. And so sort of given all of this, and I'm just kind of conscious of the time, I think it's safe to say that more work is needed to build charities to investment readiness, and that it's going to take time. But if I do have a minute or two, I just kind of want to make one kind of point about the importance of an enabling environment, because I think this is a good point worth making. I think the sort of idea of an enabling environment for the charitable sector can sort of get lost in this conversation about social finance, but is actually quite important because an enabling environment for the charitable sector would actually lead to conditions where charities would be better positioned to take advantage of social finance. So there's an interesting report from Social Investment Business. It's an organization in the UK that has managed several investment and contract readiness programs. And they note that instead of focusing on investment readiness, somewhat counterintuitively, we should be focused on building organizational resilience, and that this would likely result in a greater number of investment-ready organizations. And so I think advancing policies that will ultimately strengthen the organizational resilience of the charitable sector organizations, policies such as maybe a home and government for the sector, grants and contributions reform, data for the sector, this will actually lead to a greater uptake of social finance capital. And then not to mention advancing other policy reforms that allow charities greater freedom to engage in earned income activities, such as implementing a destination of funds test or clarifying CRA guidance around related business, or greater access for charities to innovation and business supports that small and medium-sized businesses have access to. And so, yeah, what do you think, Chancel?
We have a couple questions here that we can tackle. There's about 5 that are tabled from our participants. If you want to answer them,
sure.
We can take the remainder of our time for a little Q&A.
Sure, yeah.
There's one that you somewhat just touched upon by mentioning the UK, and this question is from Carla. Has similar research been completed for nonprofits and their awareness and use of social finance or repayable debt?
That's a good question. I apologize for the rambling answer that I'm going to give you. I feel like I've seen a survey, I'm not sure, closer to the 2010s. I feel like there was a survey conducted by the Ontario Nonprofit Network, maybe in partnership with another organization, where they did a survey on the topic of social finance. And I can't quite recall whether they looked at awareness or not. But my memory is a bit fuzzy when it comes to that. But aside from that, to my knowledge, there hasn't been any sort of comparable survey on the topic. But that's to my knowledge, anyways. There very well might be.
Nathan asks us, did you find some significant differences in results based on provinces/regions?
Yeah, for sure. I mean, yeah, for sure. I think some of those differences, just trying to think. So in terms of barriers, it's really difficult because for each barrier, there can be we looked at how 8 to 10 variables interact with each of the barriers. And so for some barriers, we see that, regions doesn't really have any sort of significance. But there are a few barriers where I think in that barrier section, there are a few where I think we did find significant results by region. And there are a couple presented in the report, and unfortunately, I can't remember the specifics of what they are. But in terms of organizational capacity, we did find that Quebec, registered charities located in Quebec, they tended to report strong organizational capacity across, I think, all areas except maybe management and governance. I can't quite recall, but Quebec was definitely a theme there for sure.
Natasha just shared in our chat box, but she only sent it to the two of us. I did a survey on social finance with Charity Village about 10 years ago, and in parentheses she writes, Give Green Canada. So if anyone wants to research that, it's an assessment from about a decade ago. Gina asks, sorry if I missed this, but did the survey ask major donors and board members if they would be open to these alternative models of financing, or just the charities? She's wondering if the charities' perspectives are disconnected from their funding base.
Uh, I guess I'm curious to follow up on the last part of that, and in terms of if you could elaborate a bit more in terms of what does she mean by disconnect from the funding basis. But to answer the first part, so we only surveyed registered charities. We didn't ask any questions about that were kind of directly aimed at board members or so on. Although there were, in terms of people that were filling out the survey, the majority of these people were charity leaders. So I think 80% were either presidents of their organization or CEOs or board chairs. But there wasn't any sort of specific question kind of tailored directly to board members. But
We got two more. So let's go with Katie's. Thank you for your answers. Based on your research, do you feel there is a barrier for scaling social finance because of a lack of social finance knowledge and limited intermediary infrastructure? In parentheses, among other reasons that you've already discussed, of course.
oh yeah, for sure, I think so. And kind of starting with the last point first, the sort of intermediary structure. I don't know as much about that, but from kind of my general sort of sense of it, that is sort of a structure of the social finance market that does need to be developed, and it is sort of the core focus of one of the IRP partners. The idea of developing that sort of intermediary the intermediary kind of component of the social finance market. And then I definitely think that at least looking at our results, that the awareness of social finance, the low awareness of it is sort of it seems to be a substantial obstacle. And that, I think in order to be able to scale social finance, I think that sort of starting with awareness and starting with education about social finance is sort of a precondition. Like it's not, it's sort of like the start of the process, I guess. So you start with greater awareness, you start with greater understanding of social finance, and how can you use it, what are the benefits to your organization, what are the risks, and that's sort of like I think it's a precondition for making informed decisions about whether social finance is something to be pursued or not. But yeah, for sure.
So there's actually 5 questions left, but I'll take one last one
Sure.
and leave you the last word. And after that, I'll do a bit of housekeeping at the very end. But let's go with, out of the 5, what impact has COVID-19 crisis had on charities' investment readiness?
Yeah, for sure. So I think, so Imagine Canada conducted a survey looking at the effects of the crisis on the charitable sector in, I think, April. And, some the other nonprofit network leads have done similar surveys in their sort of regions, looking at how their nonprofit sector has been affected by the pandemic. And, we sort of see the devastating impact that it's had, loss of revenues, sizable loss of revenues, loss of capacity, layoffs. It's kind of a dismal picture. And so I suspect that if charities were likely not ready, if many charities were likely not ready for social finance before COVID, which is when our survey was conducted, I would sort of suspect that they would be even less ready now. That's sort of that would sort of be my guess to it. And yeah, maybe I can just sort of leave it there. I think that kind of captures generally.
Well, this was a very informative, entertaining, loved it. I'm very excited that Webinar Wednesday is back, and I'm really glad that you were able to join us for this very first episode of this quote unquote season. Just want to remind everyone, you're all going to receive copies of the slides with Adam's integral biography within it, contact information as well if you want to reach out to him with more questions. You're going to receive an automatic email with slides, recording. You can share this with your colleagues, and we're back again next week. Next week, it's a French webinar. Things coming up. We have a 6-month check-in on COVID. We have a webinar on the Quebec response. I'm working on a webinar on Black foundations. Lots of interesting stuff rolling out. And we have one on migrants and newly arrived Canadians coming up too. I think that's in a week or 2 weeks from now. But yeah, so check out pfc.ca/COVID-19. sign up for our digest, and that way you'll get informed of all of our webinars. Thank you so much, Adam. And I wish everyone a great, great last nice warm day. At least for me in Montreal, it's 26, and then tomorrow it's back to 10 degrees. But thank you, everyone.
Thank you very much. Thank you, Jensen.
Bye.